The broadcast is now starting. All attendees are in listen-only mode.
Hi, this is Dan Nathan and Stephanie Link, co-portfolio managers of the Actions Alert Options product from TheStreet.com. Steph and I are on the call tonight just to really do an overview of the Actions Alert Options product, talk about some strategies that we're going to be employing during Q1 earnings season, but also to give you a quick rundown of kind of how we see the world. And I was going to kick it off with Steph real quickly to just kind of talk about the portfolio. The markets have obviously been a bit volatile over the last week or two. Things seem to have settled just a little bit today, but maybe Steph was going to give you some color on how she's thinking and looking at the portfolio in this kind of market, and I was going to touch on just kind of the broad market, some technical and some volatility aspects.
Great. Well, hi, everybody. Thank you so much for joining us. I will be kind of brief. I think that we're going to learn a lot over the next couple of weeks, and that is earnings season. Obviously, we started off tonight with Alcoa, and I'm pretty encouraged by the commentary of what the CEO was saying, and we'll listen to the conference call a little bit later. But earnings are really going to be key for the markets, and I think that as we progress through earnings season, we will hear that things are getting a little bit better in the U.S. And that globally things have stabilized. China is no worse. It's kind of, for now, that 7.5% kind of GDP. Europe is certainly not growing, but getting a little bit better, and certainly the ECB being very fully committed to monetary policy, any kind of monetary policy stimulus is going to be a nice put for that market. And Japan certainly continues to be very aggressive on their aggressive actions on their monetary policy. So you've got global easy policy, and here in the States we're less so because we don't need it. We don't need emergency policy. Our economy is getting better, albeit at a very, very slow pace. But you look at PMIs, ISMs, auto sales, retail sales, even housing. The numbers are pointing in a better direction. And again, we have a long way to go, but even the job market and the non-farm payrolls last week was somewhat encouraging in terms of the participation rate. What we do for Action Alerts Plus is we have a diversified portfolio. We have anywhere between 35, 30, 38 names. We have a little bit on the high side right now just because we've seen so many opportunities, but it's diversified. It's we have a cyclical bent because we do think that the economies are getting better, and that you want to have stocks that have exposure to those that will see a faster recovery to their earnings. That said, we also still have some defensive, some staples, some healthcare, and I think that we're pretty well positioned into the quarter. We always have a little extra cash on hand, and we've been raising cash over the last couple of days, couple of weeks, especially as we've seen the sell-off in the high beta, high flying growth sectors. We want to have a little extra cash on hand so that we can buy the dips, buy earnings season. There's always volatility, but we do think that the numbers are going to come in a little bit better, and possibly even on the top line as the economy improves. So that's kind of our backdrop and where we're positioned. And Dan has a whole bunch of ideas to help either leverage or hedge, and we're all going to learn a lot here tonight.
Cool. Thank you, Steph. I mean, just real quickly, I just wanted to touch on some of the stuff that we're pretty familiar with as it relates to the markets. I'm going to just kind of swap back and forth between my presentation that I have up there and my Bloomberg screen that's showing some charts here. I mean, this is just kind of a simple one here. This is just the VIX, and you guys hear about it talked about often, and you hear about it as it relates to the fear gauge. And really what the VIX is doing is measuring the price of options in the S&P 500. And, right now, when you think about the sell-off that we just had in a lot of these high growth, high valuation names, the VIX really didn't get going here. We just had this 2-day period where it saw a little bit of a spike. It got back down towards 1-year lows. And I think, to me, that showed a little bit of possibly, you could look at it a couple ways, maybe a bit of complacency, but maybe it's just that what's going on, people feel pretty decent about. They saw a rotation out of some sectors or individual names that just got really overzealous, and the money moved into, even in the case of the Actions Alert Plus portfolio, into names like Johnson & Johnson that broke out to new all-time highs. Procter & Gamble's held in right there. So it moved into some of these more defensive names and out of some of the names where the valuations just didn't make a whole heck of a lot of sense. And then I would just add, a couple things. I mean, we talked about the rotation. When you look at the S&P 500, when you think about Friday morning after the non-farm payrolls number, the S&P opened up at a new all-time high, and the damage that was done in the last couple of days, look where it stopped. You see that purple line right here where my cursor is? That's the 50-day moving average, which is still rising. What did it do today? It came right down to that level that was technical support, and it stopped there, and it had a little bounce. So to me, that is a really pretty healthy action if you think about it from the all-time highs. I guess I would just add one more. Let's look at the NASDAQ composite here, okay? And this one looks a little different. This one basically was much farther ahead on certain technical terms or indicators that you would say. It was much higher off of its 200-day moving average, and it's about 5.5% off of that high that was made in March, which was really a 14-year high since the internet bubble. And this one's going to take a little more time, but when you think about it, it broke through that 50-day moving average, which was support, and now you see where my cursor is, the prior low in February, that's probably a good near-term target to see some support. But from where I'm looking at things on a technical basis and from a volatility basis, I don't see the sky falling. You saw in individual names that just got ahead of themselves, I think, but I don't think that any of the price action that I see, at least in the options market, suggests that a crash is here and coming, that sort of thing. So with the kind of macro out of the way, we wanted to kind of hit on, Steph and I thought this would be a great opportunity to kind of talk about some strategies that we've been using in Action Alert Options and some of the strategies that we're going to start using more, especially in a period like earnings. When you think about individual stocks, there's really 4 events that you can take to the bank, okay, that could have the potential to cause unusual volatility, and that's their quarterly earnings. And so here we are. I'm just going to go through some of the inputs that we use to kind of arrive at the option structures that we're going to use around some of the Actions Alert Plus holdings, especially during earnings season. But as you guys have heard us before, probably on these calls or possibly on some videos on the web, on thestreet.com, we use options with stocks for 3 primary reasons. One is to add yield to an existing position. Well, another would be to add leverage to an existing position. And the third, and I think the most important, would be to risk manage existing positions. And so I'm just going to run you through real quickly some of the inputs that we use when we're trying to figure out what we think, the criteria for a trade on an individual stock would be and what some of the inputs are. So first things first, and I just want to make this point that I, like you guys, are Action Alert Plus users, okay? I'm going to just bring up the screen right here real quickly, okay? This is the Actions Alert Plus page here, okay? And I have the weekly roundup right here. I think these are great updates to kind of get a sense for where Jim and Stephanie are on these names, what they're thinking about doing, what their targets are, how they're changing, that sort of thing. So I use that kind of frequently, and I encourage all of you guys to do it also. And then the other page that I use a lot is this portfolio page. And this is really helpful to me because it gives me a sense. I just looked at what their targets are, but I can get a sense for their cost basis. I can get a sense for how frequently, when they bought last, when they sold last, that sort of stuff. So that's really important to me, and I hope you guys are using it because I use it a lot when we're trying to evaluate the strategies. So that was the first one, the Action Alert Plus view. We're relying on their fundamental view, on their valuation work, on the work that they're doing around identifying the next catalyst, whether it has to do with product cycles and corporate actions, that sort of stuff. The next one is kind of an important one, and this is one that you guys are going to rely on us for, and I hope that we help educate you guys on how to figure a lot of this out on your own, because some of this stuff should become second nature after a certain period of time. But really getting a sense for what is the options market implying what sort of movement is it implying in the underlying stock? And this is something that it's interesting. When you're just looking at a stock and you're looking at fundamental inputs, you're not going to be able to figure that out. But if you look at the stock and you look at the options on the stock and you look at the pricing of the options on the stock, that's how you back into some of this stuff, and you get a sense for what the implied move is. We're going to go over that in a little bit. And then another one, this is really important, and Steph often refers to analyst upgrades and downgrades and how they're basically changing earnings estimates and that sort of thing. But these are things that we look at. I'm going to bring my Bloomberg screen over here, and I'm going to show you. I'm just going to pick a name. I'm just going to pick Johnson & Johnson. That's one of their holdings here, okay? And when you look at this, I like looking at charts, and to me, what does that say? Well, it says it's a very strong chart. It just broke out to all-time highs. But when we just talk about something like sentiment, it's really important for me to get a sense for how the street is on the name, because if everyone's has a strong buy and a price target well above where the stock's trading, there's really not much further for it to go in some ways when you think about when you're incorporating sentiment into your analysis. But in this situation, there's 15 buys, 9 holds, 1 sell. I'd say that's kind of neutral for all intents and purposes. I'd say it's pretty bullish. And the price target is 102, which is just a little bit above, maybe a few percent above where the stock is trading. I'd also take a look at short interest. This is also important. If you get unexpected good news, this could cause the stock to rally. Well, I look at the percentage of the float, it's 1%. A stock like Johnson & Johnson, you wouldn't expect it to be very high. So those are some of the inputs that we use when we're trying to get a sense for how the market is pricing something, because sentiment's a very important component to that. The price action and the technicals we talked about, we look at them very closely. In almost every alert that we do in Actions Alert Options, we will give a technical view, because in a lot of ways, the technicals help us inform the strikes that we choose, the option strikes that we choose around the underlying stock. And then the last one is volatility. And this is one that I think that a lot of people new to options, and maybe a lot of our readers in Actions Alert Options, this is one that's going to take a little uphill. It's going to be an uphill learning process, and that's what we're here for. We're going to guide you through it. We're going to do I don't know if you guys have, hopefully you're noticing on Monday mornings, we're doing these weekly educational analysis where we're breaking down one trade from the previous week, and we're really trying to kind of interject some more sophisticated options terms so you guys get familiar with them, breaking down, tell you what they mean. So that's a really important and probably the final point that we use to evaluate what strategies we will use. Okay, so moving along, I want to give you guys an example. Apple. This is a action alert holding. Excuse me. And I'm going to walk you through a little bit. This is just an example. We don't currently have any overlays on Apple right now, but really one of the most important things as we head into an earnings event on an underlying stock, we're going to get a sense for what is the options market implying, okay, and how much has the stock moved on average in the past. And that can give us a sense for how traders, investors are feeling about the name heading into the event. In this situation right now, and Apple is scheduled to report on April 23rd after the close, the stock on average has moved about 4% up or down one day after they report their earnings over the last 4 quarters. On an 8-quarter average is about 5%. For one of the largest, or for the largest market cap company in the world, that's a big move. We're talking about tens of billions of dollars that Apple is moving on the day after it reports earnings, okay? And so that's really important, and I think we're going to, as we get into a lot of our earnings previews over the next week or so, we're going to constantly refer to implied move versus the average move. So really, to give you guys a sense, though, how do we figure this out, okay? Apple, on average, moves around a little less than 1% a day. So that 4% implied move for Apple is suggesting a pretty big move. If you do the numbers, I'm just going to do Apple's market cap is, 466 billion, okay? You're talking about, a $30 billion move if it's outsized one way or another. Last quarter it went down 8%, so we're talking tens of billions of dollars. Okay, so it's really important to see how much the stock is moving, how much is expected to move, and how much it's moved on average in the past. So when you hear us talk about the implied move, this is a really kind of back of the napkin way to do it. We're going to do a post, and we're going to work through some of the more technical ways to get exact estimates. But let me just give you the example in Apple, okay? Assuming the stock is about $525, and assuming that like I said, they're reporting on April 23rd, and there's weekly options. The April 25th, that's the Friday after it reports, 525 straddle. Okay, what is a straddle? A straddle is buying the put and buying the call in the same expiration of the same strike. If you bought that straddle in Apple, let's just say hypothetically the 525 strike where the stock is trading, the put was offered at $15 and the call was offered at $15. It would cost you $30. To make money owning that straddle, you're basically owning the earnings move. By Friday, April 25th expiration, you would need a $30 move in either direction. Okay, doing the math, what does it come out to? It's about 5 or 6%. But here's the thing, okay? The deal is we have a couple weeks to that, so there's time value in there. But if you were to do that the week of, you're basically isolating the move and there's no time value. And that's a really good, I think, little trick for some people at home to try to figure out what the event move is right before the earnings event. But we're going to do some more work on this topic. But I think that's a really important topic. I think for most investors, maybe they're not even trading options. To get a sense for that sort of stuff, I think is very important. So let me just move on here to the other inputs. And so how do we use the technicals? You know, we just kind of figured out what the implied move was. It's about $30 in either direction, okay? Well, look at the chart here, okay? This is the 6-month chart of Apple. And you see the red line that my cursor is going over. That's the prior high right before the prior earnings, okay? And look at the green line. Okay, that was the low after the gap down on the earnings. And when you look at that range, that's a $60 range, okay, with $30 on either side of 525. That is basically the straddle. When I tell you that these options market makers figure this stuff out pretty clearly and they do it mathematically, it's no joke. So when you look at the technicals, and then we looked at the quantitative, we looked at what the options market was pricing for it. So it's basically, you know, right in line with where you would expect technical resistance to happen up at 555 and support down at 495, which is a really important point. And like I said, we're always going to incorporate the technicals with these other inputs. All right, so choosing strikes, and this was the last one, and this is the one that, you know, we wouldn't expect a lot of readers right off the bat to kind of have under their belts, but one of the most important inputs when we decide what sort of strategy we're going to use around an underlying stock price, and whether it's going to be a long premium or short premium strategy, meaning owning options against the long stock or being short options versus the long stock, is going to be the last one. It's going to be implied volatility. And what is implied volatility? Very simply, it's the price of options. It's what option traders expect. Or it's you know, there's a whole host of factors that go into it, but when you think about it this way, here's Apple's implied volatility over the last year, okay? And you see that it's ranged at the highs in the mid-40s. This is about 45 where my cursor is right here. And on the low end, where it just got down to below 20, okay? The stock was stuck in the mud. It wasn't moving. Options market makers did not expect movement. Therefore, they were sellers of options, and the price came down pretty hard. In the last week, the stock sold off a few percent, and it's popped up. We're also getting closer to that earnings event we talked about. And if you look at this, these blue E's, that's where earnings, okay? So what happens to options into earnings events? They start to rally the price of options. There's greater demand for it, and the prices of options go up. So I think right here, you know, there's a lot of things that you could consider about the price of Apple on a relative basis. They look kind of cheap, the options, but they've also picked up a little bit in the last week. All right, let me just move this on because we're going to get to some real-time examples. All right, give me one sec here. Timing is really important, okay? And so what did I just mentioned that the price of options are likely to tick up as you get closer to the event. Apple options just started to tick up, but when you think about it, we're more than 2 weeks away from the event, and picking the strikes, you got to be really careful because the strikes that you would choose right now with a stock where it is at 523 may not be the strikes that you want when you get to that event. So that's really important. I'm not going to belabor the point too much, but you're going to see us in practice do this more often in the next week or two. All right, so let me just give you a really quick example of a theoretical trade that we would use in Apple right now. Obviously Steph bought a little bit more today. I think she's probably, she thinks that the stock could be range bound right here, but you know what? The company bought $14 billion worth of stock in early February, an accelerated buyback, after that disappointing earnings report when the stock was just below, if they started buying it when it was just below $500. I think a lot of people think that there's going to be good support down there, but the flip side of it is the stock has been unable to break out on the upside when it gets up to that 555, 560 range. So one strategy that kind of we would consider in a range-bound stock like Apple, especially when you're considering the fact that the real catalysts for the stock are going to be, August, September, with the launch of new iPhones that have been talked about, and possibly a whole new a whole new product category for them, which would be the phablet, something in the 5.5-inch range to compete with Samsung. So to me, there's potential that you don't have people upgrading their iPhone 5 to the iPhone 5S over the next quarter or two, and that possibly, while earnings estimates are not particularly high, maybe they come in line to slightly below, and the stock remains range bound. The worst case scenario is that people are just wrong about that psychologically important 500 support number on the downside. They're wrong to think that maybe the company steps back in with 5, 10, 15 billion in accelerated buyback, and if the company does miss and they do guide down, maybe the stock breaks through there. Under that scenario, here's a company, Apple, that pays a 2.3% dividend yield. We know that they have 150 billion plus in cash on their balance sheet. It's a slow grower. There is the option that someday they redefine a category or create a new category and the stock goes back to 700, but it ain't happening in the next 2 quarters, okay? Now, the worst case scenario is that, like I said, the thing blows up. I don't know. It's not going to blow up, but just the worst case scenario, okay? Maybe you want to get some protection on the stock, but you want to also participate with some near-term upside in that range that we identified. So to me, an easy strategy on a long Apple position would be a collar. And what is a collar? Very simply, it's basically selling a call against your long stock position and using the proceeds, using the premium that you take in to buy a downside put. You basically collared the stock. You've created a band in which you can make money to the upside on the stock, that you can lose money on the downside of the stock, but you're also protected below a certain point. So in this situation, and this is, again, hypothetical, we're not doing this trade, but I think it's really important, and when we talk about some of the inputs that go into our trade, we will look closely as we get to April 23rd or before the event, where the stock is, where implied volatility is, what's the range, what's the implied move, all that sort of stuff. But right now, if the earnings were tomorrow, and let's just say you were comfortable with $25 or $30 of downside, this is a strategy that we would possibly employ to participate on the upside but protect on the downside, and this would be a collar. And we're going to go into greater detail.
And Dan, there's a typo on that. It should say 490 put.
Okay. All right.
You see that? Okay.
So, yeah, 490 put. So it would be the 490 put and the 555 call. All right, moving on here. Here's one that you guys may be familiar with. We just put this alert out today in IBM, and this is a really interesting one, and I just want to lead with the technicals because that chart, while I put a lot of fancy lines on it, it's kind of interesting. Here's a stock that has just underperformed the broad market. It's underperformed most of its tech peers for a very long time. When you look back to those 3 lows over the last, that was in the spring, summer, and just recently in February, this last one, the stock has rallied 12%. And it's really now kind of coming up right against this prior resistance level, this technical resistance level. And for all intents and purposes, the stock has acted very well during the sell-off in the last week. It's been the beneficiary of this rotation out of some higher growth names and into kind of slower growth and kind of defensive. The last line I put up here is at 210. And what is that? That's the actions alert. That's their target, 210. Okay, so to me, this sets up kind of interestingly. The stock's had a nice rally. Investors have come around to see this thing. There is an event next week. They report Q1 earnings on April 16th after the close. It's not a company that gives a lot of forward guidance. They will guide on some levels. But to me, the implied move is about 4%. That's about $8 with the stock right here. And you know what? The stock's moved a lot over the last 4 and 8 quarters. So in this situation, we thought about getting some protection back towards these lows. And really, we didn't want to pay a whole heck of a lot for it. The stock has some momentum. Sentiment is very poor. And if the company is able to put up a better than expected quarter with some of the underlying metrics better than they've been over the last year, there's a good shot that you see the stock over 200. So what we didn't want to do is give away a whole heck of a lot. We didn't want to give away any upside, but we wanted to put some protection on that in case the company just lays an egg and gives murky guidance, and the stock heads back towards those prior lows, that at least you've protected a portion of the position, especially given the fact that it's new. So in the situation today, when the stock was about 193.40, okay, we bought a put spread. And really simply, a put spread, it's not too different than just buying a put, but yet we're selling a lower strike put in the same expiration. And really what we're doing there is we're trying to take in a little premium of the short put to offset some of the premium of the long put that we're paying. Again, we did not want to pay a whole heck of a lot for this protection, but given the fact that the implied move is 4%, the stock has rallied 12%, it's hitting up against resistance. There is I would say, a pretty important earnings event, especially after a couple of misses where the stock has acted pretty poorly. So in this situation, we just bought one of the April 185 puts for $1.20. We sold one of the April 175 puts at 25 cents. That cost us 95 cents. And this is really important, okay? If the stock goes up from here, you'll lose that 95 cents, okay? But you have that protection to the downside. So there's always a trade-off, okay? And between 193.40 and 185, essentially, you also lose that premium that you paid for it. Where it becomes really important, though, is between 184.05 and 175, you have up to $9.05 of protection if the stock were to go back towards those lows. Again, we view this as a low probability event, but there is an earnings event, and we just thought that looking out there and looking at the options prices, being fair for all intents and purposes, they've ticked up. They're not particularly cheap, but they're not either expensive. We thought looking at the technicals, isolating that 175 level under a worst case scenario, we thought that this looks like pretty cheap protection. So, I'll just leave it at that. But this is not something that, you want to go out and buy puts on every stock that you own that frequently. I would say that IBM is a controversial stock. And, if this quarter, surprises to the upside, I think you can see the stock above 200. But if they really disappoint after the recent move, maybe you get that, $5, $6, $7 move that's implied. It's really implied 8, but maybe it's a bit muted. Okay, so that was the protective structure from today. Give me one sec here. All right, let's look at Costco. This is also another new actions alert holding, and this one was really interesting to me. I mean, this stock was a monster for the last couple of years, really, moving in lockstep with the XRT, the retail ETF, and really a retail leader until they had a series of disappointing sales misses. There was a whole host of reasons for them. The most recent one is obviously weather, and you see that gap a month ago where my cursor is circling right there in early March, and the stock worked its way lower, and look at that. It came down almost exactly to the 2 prior lows over the last, this is a 6-month chart right here, over the last 6 months. The stock got a really nice bounce today. The Action Alert Plus average is about 113, which is just about where the stock closed today. Next week, we've identified an event, same-store sales in March. This is going to be a really important number, in my opinion, because if they can buck the trend over the last couple months and kind of have some, hey, Steph, I don't know, this is not an event where there's a whole heck of a lot of commentary. They issue a press release, but I think it's probably one of those things where investors can kind of gauge the direction of business, especially after they've had data points over the last couple months. But so this is one where they own it right around here.
It'll be interesting to see though, because people are starting to expect that they're going to see a snapback in terms of retail sales in general after the winter months. So if they can actually deliver, and it'll probably, in retrospect, once you look at the number, will react, but then in retrospect, you look at others that I don't think will be nearly as good. So it could certainly be a spark to get this stock higher. That's kind of what we're betting, and we think at 110, 111, the stock's discounting a lot worse than that.
Yeah, and so what we did here is we did a leverage trade, an overlay trade to their existing long position. We really liked their entry right above support at 110. And so what we wanted to do, because as you guys know, I mean, Steph and Jim, they trade around these positions. Stock comes in a little bit, they buy a little, it goes up 5-7%, they maybe sell a little out, that sort of thing. So what we're going to try to do is replicate some of the trading that they do when we think there's certain inflection points. And so in this situation, just move it over here. If you look at this chart, I mean, the breakdown level, okay, from about 4 months ago was at 120. You know, and it looks like that gap level from just last March is about 116. So we kind of wanted to isolate between the green line and the red line as a potential spot to find what we deem to be cheap defined risk leverage. So I'm going to just kind of pull up a trade that we did last week here. And this was against 100 shares of stock. And I just actually want to make a good point, because we just got a question here from somebody, and it may be somebody who's not an Action Alerts options user. We will always be very specific whether the option trades are against underlying stock, whether they are to replace stock. And this is a really important point about the product, because generally a lot of what we're doing is going to be against shares of stock. And we are always going to use, as just a kind of simple way to do this, is 100 shares of stock. We're going to isolate 100 shares of the position, and we're going to trade one options contract against it, okay? So this was last week on April 4th when Costco was at 112. We looked at this event, but we also wanted to give it more time, because I don't believe that this is a story that steps in for the next quarter. I think that they think that the stock is undervalued. I think they think that they're going to see a reversal of certain trends that cause the stock to underperform. And we wanted to give ourselves some time. So we looked out to July, and we bought the July 115, 120 call spread. Much like the put spread I just described, not too difficult. We're buying one 150 call, 115 call, and we're selling one of the July 120 calls against it, okay? And what we did was that cost us $1.35. That is our maximum risk. Our break even on the upside on that trade is at 116.35, and between 116.35 and 120, we can make an additional $3.65, almost 2 times what we were risking to do. And when you think about sentiment, you think about the technicals, we looked at the options that looked pretty reasonable. We thought this was a pretty decent way to add leverage to the existing position with defined risk, to a level that we think is very achievable over the next few months if the fundamental thesis plays out. So that was a trade, a leverage trade that we did last week. So really, you know, I mean, these 3 trades, and I'm just going to quickly just kind of run through it. The first one was really a protection trade. It was a collar. The second one, an IBM, was also a protection trade, but it actually afforded us unlimited upside potential. And the last one, in Costco here, this was kind of a leverage play. And why would we use a leverage play? You know, we do them when we think we have events that can help catalyze the stock to move, and that's a really important point. So the last one that we really didn't kind of speak to was yield enhancement. And yield enhancement, you know, oftentimes on the product we'll talk about just simple overwrites where you're long a stock and you sell a call against it to add some yield to the position. And you do this if you think the stock is kind of range bound or fully valued, or maybe the price of the options have gone up. But, you know, to be very frank, we're probably not going to do a whole heck of a lot of that during earnings season. You know, Jim and Steph, they're great stock pickers, and, you know, we want to obviously give the positions as much room to run, especially around catalysts. So when we usually do overwriting is when we think a stock is kind of in between events where there's not a whole heck of a lot expected to come out, and looking to pick up, like, let's say 1% or so over like a month or a month and a half, that sort of thing. So that's when we're going to use those sorts of strategies. But so that's kind of the main strategies that we're going to be talking about over the next month or so as we get into Q1 earnings season. Listen, we really would love to hear from you guys, things that you'd like to see in the product, things that, strategies that maybe we talk about a lot that maybe you don't understand and you'd like to see more emphasis on. So, feel free, email us, tweet us, the whole thing. So I think there's some questions here, Steph, and I'm just going to kind of collect some.
Sure.
But just give me 1 second. Here, let me see. We're going to have our moderator send some to us here. If you guys have some, just kind of throw them in there. Steph, is there anything that, as far as, before the product existed, the way you would navigate towards or in earnings season, are there some stuff that, as far as, the portfolio exists, you trade around things, right? You kind of trim, well, let's use Macy's as an example, right? I mean, you got in front of that when the stock was down and out, and you rode it all the way. You rode it through event. You and I had talked last quarter when they were going to report, and you're just like, this is one that I do not believe needs protection or this and that or whatever. Are there strategies that, that if you didn't just have the long-only mandate that you'd kind of be looking to do? And like do you equate to just buying more stock when the stock is above your average? Do you equate that as like you would be doing a leverage trade? Does that make sense to you in a way? Like, how we just added the leverage on the Costco, you're going to obviously average in as it goes up. If they report better March sales, stock goes up, I suspect you'd be buying a little more.
Yeah, when we have new positions, we always start with we try and start with like 1%. Today we started Whole Foods at 1.4%. What's hard is that we have these restrictions, and so whenever Jim talks about a stock, we can't trade it for 3 days. If I mention a stock on Fast Money, they don't really want us to trade it, or certainly go against what we were recommending, which I totally understand. And so it's hard to get around the restrictions. We try not to trade too much, but we do want to show the value in taking some gains. And honestly, when we buy a position, we actually hope that it goes down first so that we can average into it at a little lower level. But we basically, honestly, we are GARP investors. We're kind of core investors, which is a combination of growth and value. But I really like to try and get something, growth at a reasonable price. And Whole Foods and Costco, and those are Nike. Those are perfect examples of names that we think where expectations are low. What's very interesting to me, Dan, is how much these high flyers have come off. And that's why we've been adding to them. Google today, Facebook today, yesterday with ServiceNow. They've come down so much that expectations are so low that hopefully they're low enough, and if they can come in with solid numbers, that there's a good chance you can get a pop. But I always really like to watch your analysis on the options and the implied volatility, because at least it just gets me set. Like, now I know there could be possibly a $5 to $8 move in IBM. That's really important to know as an investor, just to be prepared for that and to be ready to be buying it or to sell the strength, that kind of thing.
We got a question on Facebook. Let's look at Facebook, because I know this is when you started in small, and I know that this is a story that you think is going to have lots of legs. This is not Yelp. This is not, one of these kind of fly-by-night kind of new media, right, stocks. And so, Facebook's a pretty fascinating story. I know that these guys, listen, when I started looking at Actions Alert Plus pretty closely last year, they were buying Facebook in like the low 20s, and I was like, it got me looking at it. It really did. And then they had that gap, and it kept on going and going and going, and the valuation never made any sense. And when Steph just said, GARP, growth at a reasonable price, the reasonableness of the price has gone up and up and up, and these guys have traded it phenomenally. We put a trade on when the stock was in the mid 60s, I think near their entry, and it was really just a defined risk trade. Hold on 1 second, sorry guys. A defined risk trade, a way to play towards their price target. But let's take a look at this, because Facebook, it's not really the poster child for the social internet, sell-off. It's definitely the poster child for, I think, the space, but it's also the highest quality name in the space. And so when I look at this one right here, this $60 support level that it just broke through, the other day, this is going to be, I'm just going to chart this right here a little bit, okay? This is a really important level, and I'll just show you why. This is how we're going to think about the technicals here. When the stock had this really nice move November into year end, it just couldn't get through this $58, $59 level. And what did it do on that earnings announcement in January? It blew through it on massive volume. You see the volume down here, and then it just kept on going and going and going. And the stock, just as of a few weeks ago, was making new all-time highs every day. Since then, the stock has come in, peak to trough. It was 24%, okay? And, it's trying to hold in here right now, but, listen, just on a technical setup, it's murky at best for the moment, okay? And we know that we're going to have an earnings event, so this is what I'm going to do, right? So I'm going to look here, and I'm going to find out, all right, it's confirmed on April 23rd, the same day as Apple's reporting. That's going to be a fun day. I'm going to take a look at what the implied move is. It's already 9%, okay? This is where Bloomberg's showing it, and that's not 100% accurate, but they're just taking that calculation that we used before. And then look at this. See this column that I'm going up and down with my cursor right here? This is how much this stock has moved on each earnings event. It was up 14% last quarter, only 2.5% the quarter before that. Look at that one. You remember that one last July? 30%, okay? The stock for a market cap company of $150 billion, that's some serious movement, okay? So these are all things that we're going to look at as it relates to Facebook. Short interest, you know what? It's come down massively. I mean, the move in the stock has just taken out tons of shorts. So this is one, that I think we'll definitely be doing something around. Maybe it's a protection trade. But here's the last thing, and this is what I think really attracts Jim and Steph, and I don't mean to put words in their mouth. It doesn't have to do with the valuation. This is a company that if you look on look at their sales, I just want to show real quickly. I mean, they're growing sales 45%. This is on last year. They had a little less than $8 billion in sales, and they're expected to have 11.4 this year, 15 billion next year. They're growing sales at a massive clip, and on an earnings basis, it's consistent with their sales. I mean, you guys, Steph, I'm sure you see it just kind of growing into that valuation when you look out 2 years or a year at 30 times. I mean, not so crazy. Is that what you're thinking?
Yeah, I mean, I don't know if we'll be in it in 2 or 3 years, to be honest with you, but right. I think that the pullback is
no, I don't even mean that you'll be it in 2, but if they give evidence in the next few quarters that there could be faster than that 30 or 35% revenue growth, and earnings really do grow at 30, 40, 50% at a clip, I mean, the stock very quickly will grow into that valuation is kind of what I mean.
Absolutely.
Right.
I mean, well, absolutely. And the thing is, I mean, look, there's a lot of things that drive this stock. But it's going to be mobile ad revenue growth, and it was about 53% of total advertising revenue in their last quarter. I could see that getting to 75%, 80% over time.
Right.
And this is the key metric for the stock. And look, they not only did they improve on total ad revenue growth in the last quarter, and they increased the percentage of mobile, but they also got 92% price increases. I mean, this company has it all. This is where companies want to advertise, and so they've got the technology, and I certainly do not think they would have spent almost $20 billion in acquisitions. Granted, a lot of that was in their stock price, but I don't think they would have gone out on this acquisition spree if they saw that their metrics and their user engagement and their revenues were decelerating. I just can't imagine that being the case. So, there are a couple of names in the portfolio that we have always said are speculative. ServiceNow is one of them. Facebook is another one. We like to have some fun. We think that there's opportunity. And the greatest thing is having the options overlay to play it if you don't want to take that risk.
Right. Cool. I mean, I think the last point for all you guys out there is a really important one. Is that this company they just spent $2 billion on Oculus, and they spent $19 billion on WhatsApp, and Steph saying that she cannot imagine that they would have that sort of confidence to make those sorts of deals in an environment where their user metrics are declining, that sort of thing. I mean, listen, we're going to know soon enough, because the thing is, in this environment, the stock would get punished if that wasn't the case, right? So we're going to think about, this is a great stock to use options on, even though that the price of options are pretty high. So yeah, all right. Well, we just wanted to touch on that one too, and then we have some questions on just real quickly, because I know we're going to wrap this up, on overall protection, portfolio protection, and this is not something that we're going to spend a lot of time on Actions Alert options, but we I do a bit of this stuff. If you guys watch Options Action, just this past Friday on CNBC, one of my panelists, Mike Coe, talked about a trade in the SPY using options to make an outright bearish bet, but also as a portfolio hedge. We're not huge fans for all sorts of retail investors using VIX options. They can be a bit tricky. They're very liquid and they trade very easily, but I don't think for a lot of people who are protecting portfolios of individual stocks that have a long-term time horizon, that it's going to actually give them the sort of protection that they want. But I think some of the more simple trades, oftentimes, and we do this on risk reversal, we'll look at a 10-point wide SPY put spread, and what we'll try to do is we'll start pretty simple like this. Here's the chart of the SPY, which obviously matches the S&P 500. This is the 50-day moving average, which is right here, basically closed just above it at 185, okay? And what was the February low? It was basically about 175 for all intents and purposes, the closing low. The 200-day moving average is a momentum indicator. This should serve as decent support. This is where, if you get a break below 1845, this recent level, 1800, for whatever reason, traders love round numbers. It's probably an area where it pauses, but I know a lot of guys, a lot of investors, a lot of gals, a lot of traders are going to be gunning for that February low. That's the level that they're going to want to protect. And so, to me, I think it makes sense if you're worried about your portfolio, you don't want to make bad decisions after a few percent sell-off, but you're willing to allocate a certain amount of premium to protect the positions that you have. I think you could look at SPY put spreads, and that is, again, that would be buying. I'll just give you a quick example. Let's just say you were worried about April expiration or April period, because we got a lot of earnings. You'd look out to May expiration. Okay, the ETF closed at 185.10. The 185 put is $3. Okay, so the break even on that to the downside is basically 182. That's where you would get protection. I mean, it's not particularly hold on one second. It's not particularly cheap protection, but it's a couple percent of your, if you're going to do it on a notional basis of your overall portfolio. If you do that frequently, that's going to get pretty expensive. So you want to do these at inflection points. You also want to do them not when implied volatility, the price of options, has ripped up. But in this situation, if you were looking at that 185 put that I have my cursor over, okay, out to May expiration, and that cost 310. What was the level that I identified on the downside? 175. That's basically 1750 in the S&P 500. You could sell that put for 85 cents. So that $10 wide put spread, which is basically at the money, would cost you a little more than $2. And so to me, I think that's reasonable protection. I think it's the sort of thing that maybe helps you sleep at night, especially if you were worried with all this high-frequency trading nonsense going on, all the chatter about it. If you thought there'd be a flash crash or this and that or whatever, decide how much of your portfolio, the notional value that you'd be looking to protect. You can calculate that by just kind of looking at the SPY and looking at the notional value of that, and you can kind of get a certain amount of protection. It's not going to be one for one, because a lot of the stocks that you own may or may not be in the index, that sort of thing. So, those are things I think, go to, just real simply, check out Options Action from last Friday on CNBC. We talk about it right there, but we got a few questions on the SPY and portfolio protection, so I wanted to quickly hit that. So that's really it. I mean, Steph and I want to do this periodically and kind of get on the horn, talk to you guys. We know it's a new product. We're really excited about it. We know that it's a topic that just doesn't roll off everyone's tongues, and we're really going to try to walk everybody through it, through our alerts, through webinars, and all the like. So thank you very much.
Thanks, everybody.
Thanks. Bye.